Hello guys, I hope you all are doing well and doing great at the same time. I've been meaning to drop this video for a very long time. I've promised to drop it for a very long time, but I have not been able to. So today is the D-Day. Today is the promised day, and this is the promised video. So guys, today's video is about fair value gaps. I am going to tell you guys what fair value gap is, what it actually means theoretically and practically, and then I'm also going to show you guys how to properly trade fair value gaps. So this is the promised video, guys. But the first question I'm sure all of you might start asking yourself is, why is fair value gap so important? Why should I even watch this video? So guys, let me tell you something about fair value gap in very simple terms, so that everybody can understand what I'm trying to say. Fair value gap is like a magnet on the chart. Fair value gap is like a magnet in the chart. Price action always comes to that zone before it continues whichever trend it's going. So that is why fair value gap is very, very important. So long as you are going to spot a very good fair value gap, then your win rate in the forex market is just going to, I don't know the exact words to use, but you are going to be winning a lot. The moment you master the art of trading fair value gaps and all that, you are going to experience a lot of winning trades in the forex market. So first of all, what is fair value gap? Fair value gap theoretically is just, in short, imbalances and inefficiencies. What do I mean by imbalances and inefficiencies in the chart? The thing is that buyers and sellers always want to be equal. No one wants to be greater than the other. So if, for example, the chart is moving, sellers are in control, the chart is moving, buyers will always want to pull back that selling pressure. Buyers will always want to pull the market up a little bit and fill in a certain zone. So that zone that the buyers are trying to fill in is called the fair value gap. Fair value gap. That is basically what fair value gap means. So that is just the theoretical meaning or definition of fair value gap. But what about the practical meaning? How do you know that, okay, this area is a fair value gap? So the first thing you need to consider when trying to spot out a fair value gap is that you need to fair value gap doesn't come between two candles or a single candle. Fair value gap always come in between 3 candles, guys. 3 candles. That is the first principle, or the first rule you need to put at the back of your mind when trying to spot a fair value gap. 3 candles, 3 consecutive candles. That is it, guys. So what do I mean by 3 consecutive candles? Now, for example, if you look at this, the market was going up, higher high, higher low, higher high, and then it came back all the way down here, but didn't break this higher low. It started going up again. So in this place, if, for example, we are trying to spot out a fair value gap, which area should you look out for? Fair value gaps can be everywhere. They are always everywhere. So let's consider this candle, this color green candle here, the last bullish candle here before this long bearish candle. So the last bullish candle, this green candle. After it, then this red candle. Then after it, then this other red candle. So let's consider these 3 consecutive candles, 1, 2, and then this third candle. Fair value gaps always come in between the first and the third candle. So it's always a space. Let me put it that way. It's always a space between the first and the third candle. What do I mean? So this is the first candle, and this is where the candle opened here but came all the way down here, and then it came all the way up here but closed here. So this is the weak. This is the last. This is the lowest part of this bullish candle, And then if you look at the third candle here, that is for the first one. If you look at the third candle here, this candle right here, if you look at it, you will get to notice that the candle opened here, closed down here, but it came all the way down here. So there was a little bit of buying pressure, but it was supposed to close down, but it closed a little bit up higher. So this candle here, you always look at the last part of the candle, the top and the bottom, irrespective of whether it's a fully bodied candle or there's a wick attached to the candle. So as you can see, both the first and the third candle has wicks here. So how do you mark out your fair value gap? Then you come to you bring out your horizontal line, or you bring out your box. Let me bring out my box. So this is my box, right? So what you need to do is you mark out the space in between this the last part of the lowest part of the first candle, and then the highest part of the third candle. So this space in between these two candles, the first and the third candle, is your fair value gap. And let me prove something to you. As you guys can see, the market was going up. Let me start right here. The market was going up, higher high, higher low, higher high, higher low, higher high, higher low, higher high, and then it came all the way down here, but didn't break this higher low. Then what happened here? The moment it started coming down, because the buyers didn't agree with the sellers that okay, we are not equal. What happened? The buyers began pushing back the price upward. It was actually coming down, dropping with high momentum. As you guys can see, this red candle, it's a full candle with no wick, which shows bearish momentum. But what did I tell you from the beginning of this video? That fair value gap is like a magnet, because the sellers created a fair value gap here. The sellers created a fair value gap while coming down. The buyers now decided, okay, since you guys left a fair value gap, and it's just like a magnet to us, and we want to be equal with you guys, what we are going to do is that we must fill in that fair value gap. We must fill it up. So what did buyers now decide to do? So the moment the market came here, they started pushing the price back upward. Price started going up, and the moment it touched this fair value gap, the moment it entered a little bit of this value, sometimes it enters deeply, sometimes it doesn't enter deeply. So the moment it touched this fair value gap, anywhere around this fair value gap is going to be your entry. So the moment you see market entering this fair value gap, what you should do is just enter for a sell. Keep your stop loss above this high, just at this high, or a little bit above it. Give the market a breathing space. That is why a lot of you guys get stopped out in a trade. Sometimes I know we don't have big equity, but growing small accounts can actually be very, very hard. That is why you should always go for a prop firm account if you don't have big equity, because you should always give the market a breathing space. Right? So what actually happened here? As you guys can see, the moment our price action tapped into this fair value gap, the next thing was the market started dropping. So your stop loss is going to be here, and your take profit is going to be this place exactly is going to be your TP1. That is where I would have targeted as my TP1, right? So as you guys can see, the market kept on dropping, and probably it did hit your TP. This was our TP, and it did hit our TP, and it's a winning trade, guys. So this is how you trade fair value gaps. I've shown you what fair value gap is. I've shown you how to trade fair value gap. If you also notice around this place, let me delete this box. If you also notice around this place, the market was going up. Actually, it was an uptrend. But what did the sellers now decided to say? Okay, since you guys left a fair value gap right here, I'm sure a lot of you guys might have spotted a fair value gap. Where is the fair value gap? This is exactly the fair value gap. Don't forget, I told you need to look at three candles at the same time in order to spot a fair value gap. So this was the highest part of the candle of this first candle, and this was the lowest part of the third candle. So this place exactly is our fair value gap. And what happened? It was an uptrend. Market said it was an uptrend. The buyers left a fair value gap here. Actually, there are two fair value gaps here. There are two fair value gaps here. Let me show you the other one. The other fair value gap is this place. The other fair value gap is this place right here. So this place up here is a fair value gap. This place right here is a fair value gap. But which one should you always go for? Bring out your Fibonacci. Bring out your Fibonacci tool. Bring out your Fibonacci tool. Sorry. This was the highest part, and this is the lowest part. Sorry for this. So this is our Fibonacci tool, right? This is our Fibonacci tool. Don't forget, I once made I don't think I've ever dropped that video in this channel about Fibonacci tool, but the thing is that this is the Fibonacci part. The Fibonacci tool has two parts. As you guys can see, it works with percentage. This is the 50% level. It might not really be clear to you guys. As you guys can see, there are some writings here: 23.6, 38.2, 50, 61.8, and 100. So the Fibonacci tool is divided into different lines. So from 100 to 50 to the 50 level below. From 50 to 100 is the discount, while while from 50 above is the premium, right? So when you want to buy, always buy from discount, and when you want to sell, always sell from the premium side, right? So that is one basic rule for Fibonacci tool. So you bring out your Fibonacci tool. How do you know the best this? As you guys can see, we have two fair value gaps here. The first one up here, and then the second one down here, right? So then what are you going to do in this case? You bring out your Fibonacci tool from this last high, from this last low to the high. That is where you put your Fibonacci tool, right? So the moment you put it like that, then you notice where the fair value gaps are. As you guys can see, these two fair value gaps, the one up here and the one down here, are all below the 50 level, which means they are all in our discounted zone, right? They are all in our discounted zone. Then what do you think of next? Even if it is where you common sense, this is a discount zone and this is another discount zone, but this one below, this fair value gap below, is in a more discounted zone than the one up here. So the common sense, a typical person that has sense, what the person will definitely do is that he will buy from this second fair value gap, right? So this is what I will do. The moment I see this market coming down with these two fair value gaps, what I'll do is I'll wait for market to tap into my second fair value gap, and I'll enter for a buy. Where will I keep my stop loss? I'll keep my stop loss here at this 100% level. At this 100% level. The moment I spot something like that, the next thing I'm going to do is I'll put my take profit. I'll put my take TP as somewhere up above this this is going to be my TP1. This is going to be my TP1, and this is going to be my TP2. This is going to be my TP1, and this is going to be my TP2, right? So as you guys can see right here, the market it went close to our TP2, but it didn't really tap into our TP2. That is why you have to be monitoring your trades. The moment you see a kind of reversal pattern, or that the market is not going to hit your TP, you just normally, as a good trader, you should be able to break even the moment you're in profit, so that even if the market decides to come back, the market is not always guaranteed. So you always have to monitor your trade. Even if the market decides to come back to retrace against your direction, you know you've set break even and you won't be in loss, right? So that is basically how you should do it. So the moment you spotted this two fair value gap, always go for the lower one, because it is in a more discounted zone than the first one, right? And everybody wants more discount whenever he wants to buy something, right? You want more discount. Let's say, for example, you went to a supermarket, and then the supermarket is now offering you two fair value gaps. The first fair value gap is giving you 10% discount, and then the second fair value gap is giving you 20% discount, which is the one below.
So I will definitely go for the 20% discount, right? That is what every sensible person will do. So, and that is what you are supposed to do. So I will always buy from this lower fair value gap, right? So in case you find yourself in a situation whereby the fair value gap up here, we have two fair value gaps. One is above your discount, and then one is below, and you are looking for a buy. The next thing you just need to do is you just have to patiently wait for your price action to reach the one below the 50%. If you are looking for a buy, if you are looking for a sell, always go for the one above 50%. That is the premium zone. Everybody wants to buy premium, right? So that is how you do it, guys. I'm sure you guys are getting value from this video. Please like this video, subscribe to the channel if you've not yet, because I'm going to continue dropping good and quality contents like this. I'm sure there are a lot of traders here that likes using price action and some likes using indicators. So I'm doing work for you both. I drop strategies with indicators and also drop strategies with price action. So whichever one you want, you are good to go for it, guys. So this is what I have for you guys today. In case if there's anything you don't understand, the comment section is open down here. Write out your questions, and please, no insulting, no bad comments, right? Let's all be good people and positive minded, right? By the special grace of God, all of us are going to make it in this forex market, right? So please, guys, like this video, subscribe to the channel if you've not, and I will see you guys in the next video. Thank you guys for watching, and peace.